What's up, you guys? Welcome back to the Average Joe Investor channel. My name is Joe, and in this video I've got a special training video for you guys. We're going to be looking at two high yield dividend stocks, ones that I think many people would rule out because, well, they just can't be safe that they're yielding that much. What we're going to do in this video is take two dividend stocks, Delek Logistics Partners, DKL, and we're also going to look at MPLX, both master limited partnerships. We're going to understand the basic characteristics like we normally cover in my videos looking at dividend stocks, but we're also going to dive a little bit more under the surface. We're going to look at their annual reports. We're going to understand how do they make money, and more importantly, how do we accurately measure to the best of our ability how safe a master limited partnership is. We're not wasting any time in this video. We're diving right in. Let's get started. Hey guys, Joe here. If you're new to the channel, make sure to hit that subscribe button below the video to make sure you don't miss any of my future videos. And if you do click that subscribe button, make sure to leave me a comment below saying you subscribed, and I promise to personally respond to your comment. Welcome back to the channel, guys. I'm glad you're here. I want to deliver massive value every time you come back for a new video, so let's dive right in. Okay, so we're looking at two separate dividend stocks here. We're looking at two of the highest yielders here, MPLX and Delek Logistics Partners LP. All right, let's get some of the basics out of the way here. MPLX, which is actually the Marathon Petroleum Limited Partners LP, and then Delek Logistics Partners DKL. So MPLX, DKL, both in the energy sector. Both have been raising dividends consecutively for 8 and 9 years respectively, which makes them dividend challengers because they're less than 10 years. You can see their 1, 3, and 5-year dividend growth rates. They don't have a 10-year growth rate yet. We've got the 3 and 5, which are respectable at 4 and 6, and then 7 and 8 for both companies. The dividend yield right here, 9.62 for MPLX and 8.8 for Delek Logistics. And you can see their average historical dividend yield are right around those same numbers here, so pretty common. Looking here specifically, we have the payout ratio based on the trailing 12 months, 70% and 63%. Now, you may not be aware of this, and I've talked about it only briefly on the channel, but most dividend stocks, we talk about free cash flow per share for our dividend payout ratio, but with master limited partnerships, it's a little bit different. We want to be more concerned with the term distributable cash flow, also known as DCF. It's a similar calculation, but it's not quite the same. This is from the Simply Safe Dividend website, which is a great resource. It talks here about distributable cash flow, the most important metric to understand. It's similar to free cash flow, and it ultimately funds the distribution in the long term. Now, the key here with distributable cash flow is the calculation might be a little bit different for every single master limited partnership, which makes it very difficult to track uniformly across all of the master limited partnerships. So we're going to need to actually go to the annual report and see what that says and how they specifically calculate their distributable cash flow. It generally starts with net income, and then we move slowly to earnings before interest, taxes, depreciation, and amortization. And then from there, there are additional capital expenditures and other small expenses that are adjusted as well. Now, the biggest difference between free cash flow and distributable cash flow is how we look at capital expenses. Maintenance capital expenditures is how much the MLP must pay to keep its infrastructure, such as pipelines and storage tanks, from deteriorating and becoming useless. And the biggest difference, like I mentioned, between DCF and free cash flow, which is used for corporations, is corporations, they aim to pay for both maintenance and growth capital expenditures out of their retained earnings. However, as it says here, because MLPs generally fund their growth spending via external capital sources such as debt and equity, growth capital expenditures is excluded from DCF. So that's the main difference between free cash flow and distributable cash flow. But the key here is, should we just use free cash flow, or is there a significant difference in what we can actually consider to be distributable cash flow compared to the dividend? So to be specific here, the way we calculate the payout ratio for master limited partnerships needs to be a little bit more specific. It's going to be dividends paid divided by distributable cash flow. And we want to make sure that the distributable cash flow is comfortably sufficient enough to cover the entire dividend every single year. Before we look at the payout ratio though, let's understand a little bit more about what these companies actually are, because master limited partnerships are a little bit unique. So if we look first at Delek Logistics Partners LP, this is their Form 10K. It's known as an annual report that they have to file with the Securities and Exchange Commission. The first key thing we have to understand here is, what is this company, this partnership? That's what it is. It's a partnership, and you can see here that it was formed by Delek US Holdings, ticker symbol DK, and its subsidiary Delek Logistics GP LLC. Now with every partnership there is a general partner. That's Delek Logistics GP LLC, which is 100% owned by Delek US Holdings right here. Then we also have the public unit holders. That's people like you and me. We can see here that this is the actual partnership, Delek Logistics Partners LP. Now, you'll notice right off the bat that Delek Holdings, DK, actually owns an 80% interest in this partnership, and we are left to fight over the remaining 20%. So right off the bat, one of the takeaways we have here is that the main parent company actually owns the majority of the shares, which can be a good thing and a bad thing. The good thing, I think, is that they have a vested interest in the success of this partnership. They want it to succeed because they have a significant amount of ownership. Now, the bad thing that could come up, that something we need to consider, is Delek likely has a very close relationship with Delek Logistics, meaning that this partnership actually relies heavily on the parent company for their income, their revenue, and their cash flow. So we're going to dive into that. You can see here that Delek Logistics primarily operates out of five states really: Texas, Oklahoma, Arkansas, Tennessee, and Louisiana, right down here. They have a network of terminals, of pipelines, and crude tank farms here. Their primary operations include owning and operating crude oil, intermediate and refined product pipelines, and transportation, storage, wholesale marketing, etc. Now this is something I also want to cover here. These are the risk factors. Every single company's 10K, their annual report, has this section. What are the risks in investing in our company? I read through this and I found some warning signs. If Delek Holdings satisfies only its minimum obligations under, or if we are unable to renew or extend the various commercial agreements we have with Delek Holdings, our financial condition, blah, 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 will suffer. Another one here, our ability to expand may be limited if Delek Holdings business does not grow as expected. Again, we're relying on Delek Holdings for the growth of the business. Again, down here, relying on Delek Holdings. Their level of indebtedness, the terms of its borrowings, and any future credit ratings could adversely affect our ability to grow our business. This is where I thought it got very interesting. Our general partner and its affiliates, including Delek Holdings, have conflicts of interest with us and limited duties to us and our unit holders, and they may favor their own interest to the detriment of us and our other common unit holders. I found that particularly alarming, considering Delek actually has an 80% interest in this partnership. Again, it says here, Delek Holdings may compete with us, which I found fascinating. So between all these risk factors and the way that it presents Delek Holdings versus Delek Logistics Partners, it's very fascinating, the spirit of the partnership here. It doesn't seem like their interests are very aligned, even though you would think that they would, since Delek Holdings has an 80% interest in Delek Logistics Partnership, the actual DKL we're looking at. Let's talk about distributable cash flow, DCF. Now, the best way to find this in the annual report is just to search for DCF or distributable cash flow. Start with net cash from operating activities, which is what free cash flow starts with as well. And eventually you make some adjustments here and you end up with our distributable cash flow. In 2020, $207 million, and in 2019, $127 million. Now that we have our distributable cash flow, let's go ahead and go over to Morningstar's website, and we're going to go ahead and pull up their financial statements to see how much they paid in dividends. To do this, we're going to go to the financials tab for the company, and we're going to go to cash flow. So we have 2018, 2019, 2020, and trailing 12 months. We're going to scroll down to dividends paid, total cash dividends paid. We can see here $113 million in 2019 and $184 million in 2020. Okay, so 2019 we had 113 million, 0.67, we'll say 113 million, divided by 127 million. That's a payout ratio of 88% based on our distributable cash flow. That's a good number. Going to the next one here, we've got $184 million in 2020 divided by $207 million, 88%. Very consistent here over the past 2 years. So distributable cash flow payout ratio for DKL is pretty solid at 88%. Again, with master limited partnerships based on their tax rules for a master limited partnership. They have to distribute at least 90% of their taxable income in order to be exempt from actual federal taxes. Let's transition and talk about MPLX. What is MPLX? MPLX is a diversified growth-oriented master limited partnership formed in 2012 by MPC, which is Marathon Petroleum Corporation, to own, operate, develop, and acquire midstream energy infrastructure assets. Let's go ahead and look at their 10K. Again, their annual report. Now, one of the things you're going to notice about Marathon Petroleum LX or MPLX here is that the network is much wider, though they are semi-concentrated in certain states. With Delek Logistics, we were in 4 states right here. We were in Texas, Oklahoma, Arkansas, Louisiana, and Tennessee, so 5. Whereas here, we are crossing multiple different segments. We've got that same area. We've got New Mexico, Texas, Oklahoma, Louisiana, down here, and then we're majorly focused here. I believe it's Illinois. I think it's Illinois, all the way up here in North Dakota, which must be the Bakken Shale. And then we're over here on the northwest with Oregon, Washington, Idaho, down here into Utah and above into Wyoming. And then we've got Michigan, Ohio, through Indiana. So we have a much larger network here, which I think provides diversification. Now, just like what we saw with Delek Logistics and its parent company, Delek Holdings, in this same case, we've got a very significant relationship between Marathon Petroleum, MPC, and MPLX. It says here, we continue to have a strategic relationship, which is a large source of our revenues, which I think is a trend with master limited partnerships. We have executed numerous long-term fee-based agreements, blah, 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 blah. Now, as of December 31st, 2020, MPC owned our general partner and approximately 62% of our outstanding common units. So MPC has a smaller interest in this master limited partnerships than we saw with Delek Holdings and Delek Logistics. 62% here versus 80% in the other scenario. Okay, so here's our organizational structure. Just like with DKL, we can see the same type of general structure with MPLX. We've got the parent company here, Marathon Petroleum Corporation, MPC, which has a 62% ownership interest in this partnership. And then we are left with 38% of the remaining units. Now this part is very fascinating. Looking at the difference between the actual MLP, the Master Limited Partnership, and the parent company, and how the relationship is portrayed in the annual report. We saw that there was, I wouldn't call it tension, but just the way that it was represented in Delek Holdings and Delek Logistics, it didn't seem like it was a very strong relationship. But if we look here, one of our competitive strengths, already sounds better, is our strategic relationship with MPC, which is the largest crude oil refiner in the US in terms of refining capacity. They own and operate 13 refineries in the West Coast, Gulf Coast, and Mid-Continent regions of the US, and this is key here, and distributes refined products, distribution here, through transportation, storage, distribution, and marketing services provided by its midstream segment, which primarily consists of MPLX. So it is the main asset that MPC utilizes to distribute their assets. MPLX, through its fuel distribution services, distributes refined products under the Marathon brand through an extensive network of retail locations owned and operated by independent entrepreneurs across the United States. Again, MPC retains a significant interest in us, primarily through its 62% ownership of outstanding common units of MPLX. And given MPC's significant interest in us, we believe MPC will promote and support the successful execution of our business strategies. So just the difference, if we juxtapose how Delek Holdings and Delek Logistics compare their relationship, which again was still a significant interest, and we look at how Marathon Petroleum Corporation over here versus MPLX's relationship, I am much more confident over here looking at MPC versus MPLX versus over at Delek Holdings and Delek Logistics. And I feel much more confident that over here this relationship is going to be stronger, and there's a lot more diversification with Marathon Petroleum's brand as well. Okay, let's go ahead and talk distributable cash flow. Okay, so we're here on page 70 of 226 here. We've got 2020, 2019 results of operations. We have to scroll to the bottom here, and we can see what the actual distributable cash flow is right here at the bottom. DCF attributable to GP and LP unit holders, including predecessor results. 4.2 billion right here, 3.978 billion right here for 2020 and 2019. We need to come over here to Morningstar and look at their dividend payments as well. We come up to MPLX here on Morningstar, go to the financials tab, and we're going to go to the cash flow section to see how much did they pay in dividends in 2020 and 2019. 2020, 3 billion, 2019, 3 billion. 3.00 versus 3.03. Okay, so we've got our calculator here. 3.00 billion divided by 4.2 billion. 71% of distributable cash flow for the payout ratio. So that's really strong as well. 2019, same idea. 3.03 billion divided 3.978 billion, only 76%. So that's even safer than what we see with Delek Holdings. Okay, so what do we do with this information? Now that we know how the relationship works between the parent company and the master limited partnership, and just the general feelings you get towards how that relationship looks and how they talk about it in their annual report. And then also looking at their payout ratio based on their distributable cash flow, right? Dividends paid divided by distributable cash flow, much more conservative there, what we see with MPLX and Marathon Petroleum. In looking at this information, guys, for me, I feel strongly that this is the company to invest in. This is the one that I'm probably going to take an ownership interest in when I make my next contribution. Got great dividend yield, right? We've got a great payout ratio based on free cash flow, but also based on distributable cash flow. And we've got a reasonable dividend growth rate here at 4% for the 3-year growth rate and 6.74% for the 5-year dividend growth rate. I want to hear from you guys though. Make sure to leave your 2 cents in the comments below. What were your thoughts about this video? What do you want to learn more about? Did you like this format where we just dived in and really deep dived these companies? Or was it just a little bit boring for you going and deep diving this? I want to get your guys' actual legitimate feedback. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.